Hey guys, what's going on? Welcome back to Stocks with Surfing. So I just got back from vacation, and honestly, I was out there trying to relax, but every time I looked at my phone, opened up Twitter, looked at the stocks app that I use, man, the market was going absolutely insane. And honestly, it was probably one of the crazier weeks we've had all year so far. So if you look at my portfolio here, as you can see, most of my holdings, all-time returns are down. But if you remember my position in Constellation Software from last video, I was actually down negative 20 to 30% in this stock. So over the past week, it has had a tremendous comeback for me. There's other stocks that have done extremely well over the past week as well, like Netflix. So the macro environment was absolutely insane with what happened with the US and Iran when you look at that, and the price of oil absolutely shot up, which is not great for the market. But I want to take a look at my portfolio because I still think that I own a lot of great stocks that are on considerable discounts. So let's start with looking at Constellation Software. So if we look at Constellation Software on the 5-year here, you can tell this stock has had an absolutely brutal year, down 39%. But that being said, the past month has been rather exceptional. If you were to buy this thing on February 24th and hold to today, you'd be up 25%, which honestly are great returns for 1 month. As you can see, overall, I'm still down 4%, but I have a good feeling about this company. I've had my back and forth with it. If you followed my other videos, I've debated selling it in the past, but right now I'm feeling pretty good about holding Constellation Software. So let's talk about a bit about what happened and why the stock is up 22% in the past month. So on March 5th, Constellation finalized a massive strategic governance agreement with Sabre Corp. Now, this was not a friendly handshake. Back on March 1st, Sabre actually tried to launch a poison pill defense to block Constellation from buying more shares. But Constellation's team essentially told them our intentions will be clear with the benefit of time. And 4 days later, the poison pill was dead and Constellation forced them to terminate it and successfully installed Damon McKay, the CEO of Constellation Software's Vela division, directly onto Sabre's board of directors. Now, Constellation now owns 12.7% of the company, and they're officially inside the house that Sabre originally didn't want them to be in. And as you can see, that is also what triggered this big jump in stock price from March 5th all the way up to here today. So let's talk a little bit about what Sabre is. So Sabre is a global distribution system. They're the toll booth that connects over 400 airlines and 2 million hotels to nearly 500,000 travel agents. Every time a seat is booked, Sabre is going to get a little bit of that money. But here's the massive disconnect. Last year, Sabre generated $2.8 billion in revenue, yet its market cap, its total price tag, is only $630 million. That's a pretty big gap. And the reason for it, it's the debt anchor. Sabre is currently carrying $4.1 billion in debt. The market has been pricing this company for bankruptcy, with shares trading as low as $1 recently. But most investors see a sinking ship. But that's where Constellation Software thinks they can turn this thing around. Now, if we take a little break here and we look at Sabre, this is Sabre Corp stock right here, trading at $1. Now, if you go back to the 1 week, this thing is still down 2%. No, I'm going to keep an eye on Sabre because if Constellation Software can really lower the debt load and this thing can keep raking in profit like they have been, and assuming the margins are good, this could be a really interesting company to buy. Now down 93% over the past 10 years is not great, but if Constellation Software thinks they can turn it around for themselves, they're also going to be able to turn it around for the individual shareholders of Sabre. So I think this could be a pretty interesting story to follow. Maybe I'll make a video on them specifically in the future. Let me know if you would like to see that. But for today, I'm definitely not going to buy their stock because I've done zero research, and I don't recommend anyone else to buy it either because, of course, none of this is financial advice. So I also want to talk about what that does for Constellation Software. So if you've seen my videos on CSU in the past, you know that my main fear with this company was simply the law of large numbers. And since they're an acquisition-based company, they acquire smaller vertical software companies. I thought that maybe, the money was simply too hard to reinvest and get good gains on these days. I thought it was becoming too big, and that's called the law of large numbers. And I thought that was really starting to take effect. But CSU buyout is typically anywhere between $2 million to $5 million. And they have the cash to go out there and spend significantly more, but they've publicly said that's not really something that they want to do. But this Sabre deal, they paid $86 million for a stake in this company that has $2.8 billion in revenue. Constellation is proving that they can compound at scale, and they're moving from being an aggregator of small cap software to becoming a turnaround specialist for distressed giants. And I think that's where this company takes a really interesting turn. Now are they no longer looking at buying already profitable companies and just holding them for a long time and not paying too much for them. They're looking at actually finding companies like Sabre and turning it around to become even more profitable. So let's just end this with how Constellation Software is going to make money. So they aren't going to rewrite Sabre's code. They're there to install operational rigor. So Damon McKay is the Constellation Software CEO of the Vela division, who is on the board of directors for Sabre. His job is to squeeze efficiency out of every dollar. If he can improve Sabre's margins by just 3%, that unlocks nearly $85 million in extra cash flow on that $2.8 billion revenue. The extra cash is going to go straight to killing the debt. And if they can do that, then I think Constellation Software is in a great position to really help turn this company around. And honestly, it's something that I would really like to see. And if they can do it successfully, I believe Constellation Software can have more of a future than I might have pulled off than I might have stated in my other videos. So right now, I believe Constellation Software is probably at a price disconnect of about 37%. So with that being said, let's move on to our next company that we're going to talk about today. And that is once again another one in my public portfolio, Netflix. So while the rest of the market was chasing growth at any cost, Netflix just pulled off the ultimate win by walking away. On February 27th, 2026, Netflix officially confirmed it was dropping its $83 billion bid to acquire Warner Bros. Discovery. This wasn't a defeat, it was a payday, because Netflix had a signed agreement in place when a rival group led by Paramount Skydance came in with an $111 billion offer. It triggered a massive secrecy out. Netflix looked at the price tag, realized the math no longer worked, and simply said no thanks. The results, Paramount had to wire Netflix a staggering $2.8 billion termination fee just to get them out of the way. Netflix effectively made nearly $3 billion in cash just for showing up at the negotiation table. Now, honestly, for Netflix, I think it's hard to argue that either outcome are bad, if I'm being honest with you. If Netflix went through and they did acquire Warner Brothers, then I think it would have been fine. I've talked about it in my last video. They can afford the deal, and if they can put their higher margin ad service into the new content, I think they could have made a killing with that. But with that being said, if the price got too high for management, I don't think there is anything wrong with taking the $2.8 billion and walking. As you can see here, the market really liked that news, and it caused the stock to jump 1 month. It caused the stock to jump 28% basically, right? So the market really liked that news, and I understand why, because personally, I like it as well, but I didn't think there was a bad outcome to this. And this deal going through for Paramount, I don't necessarily think is a good thing. Because now if you look at it, Netflix let Paramount take the winner's curse. Paramount is now going to be saddled with nearly $90 billion in combined debt and a headache of merging two giant studio cultures. Netflix, on the other hand, walked away with zero new debt and $2.8 billion cash injection, which ironically was paid for by their biggest competitor. It's one of the most capital efficient moves that Hollywood has ever seen. To be honest with you guys, I don't think Netflix is never going to get another shot at this. Personally, I do not believe right now that I have the evidence in front of me that Paramount can actually pay for Warner Brothers, because they're going to take on the lagging cable business as well. And to be honest, I don't think they have the revenue or necessarily the free cash flow to keep up with this deal. Now, that's something that I might investigate in another video if you guys are interested in that. But to be honest, I'd be very surprised if Paramount can afford this. Netflix could, but Paramount, I don't know. They simply don't have the cash generation that Netflix does have. And another reason for this stock price increase here of 26% is there was a big narrative shift, and that's the money can go to fund new content and stock buybacks. So Netflix actually paused their share buyback program because of the pending deal between them, and if they were to acquire Warner Bros., they wouldn't be able to afford it. But now they're relaunching the share buyback plan, which means that it's just it's great for stockholders, as the company is now going to start purchasing their own stock, and it will in time inflate the price. So to summarize my opinion on Netflix here, I think Netflix is in a great position to see success for a very long time, and this is definitely a position that I'm going to look to add to. Now, I think they got an outcome that once again is really great for the stock price and really great for the company. But with that being said, I do feel like we're missing out a little bit on if this deal went through, because they definitely could have afforded it, and I would have loved to see what Netflix could have done with some of the Warner Brothers franchises, but that's honestly maybe more of a fan perspective than an investor perspective, because Netflix does a great job with their original content. So the next company that I want to look at out of my public portfolio here would be Brookfield Corp. Now, this is a company that was extremely loud while I was on vacation because of another asset manager that had some problems. And well, that was Blue Owl. And they sent a shockwave through the private credit market by permanently gating or blocking investor withdrawals from one of their major funds. They effectively locked the doors and told investors, you can't have your money back yet. The market did exactly what it always does, and well, it panicked. It started selling off every alternative asset manager by association, fearing a 2008-style liquidity crisis. But the market is making a massive mistake by confusing a Blue Owl problem with a Brookfield reality. So to understand the disconnect, you have to look at the liquidity trap. Blue Owl is a private lender that got caught in a bad spot, and investors wanted their cash, but that cash was tied up in long-term loans. To survive, Blue Owl had to fire sale $1.4 billion in assets just to raise cash. Now, if you look at Brookfield, while Blue Owl is selling, Brookfield is currently sitting on a record $255 billion Canadian in deployable dry powder. They aren't trying to stop money from leaving. They're effectively hunting for places to put it. Last year alone, they reported $6 billion USD in distributable earnings. They're not the ones in trouble. They're the ones who are going to buy the distressed assets that panicked lenders like Blue Owl are forced to sell at a discount. And if you look last year as well, they hiked their dividend by 17%. Now, I feel like hiking the dividend by 17% and then giving more money to shareholders through the dividend isn't exactly what you would do if you were concerned about a liquidity crisis. If you were concerned about a liquidity crisis, you would pause hikes on the dividend and you would potentially reduce it to keep more money for your day-to-day operations. Now, the more and more I look at it, this Blue Owl to Brookfield thing, man, they are completely different. Blue Owl is also a company that invests in a ton of AI data centers and tech, right? They are concerned and with those kinds of assets, you also have to be concerned about the current AI fears that, well, it's not really going to be that profitable, and maybe data centers is not a great business to be in. On the other side of that, Brookfield does have significant exposure to AI, whether you like that or not. Personally, I'm somewhere in the middle. I want the exposure to AI through Brookfield, but I don't want an excessive amount. And well, they currently have an $100 billion global AI infrastructure program with NVIDIA, where they're basically just building out data centers to run AI platforms off of. Now, I'm okay with that. But I wouldn't want the entire business to be AI, because when you saw Blue Owl, there was AI fears. People wanted to get their money out, and well, they couldn't because it was wrapped up in assets. For Brookfield, one reason why I wouldn't be concerned about a Blue Owl kind of run is Brookfield doesn't really own anything that's new and trendy in the sense of AI and where there could be fears. Brookfield owns things that literally can't be replaced, like infrastructure for ship ports. They own one of the biggest water treatment plants in Brazil. They own the cell towers in India. And well, in Canada, they own pipelines and real estate in downtown Toronto. They own it in Vancouver. They also own it in New York City. Brookfield is not a company that I am concerned about at this point. It is a company that, honestly, I think you're getting a really good price on it if you're buying it right now at $57 Canadian. This is one that I believe to be significantly overvalued, and I will be adding to this portfolio. But remember, this is not financial advice. And with that being said, let's look at the final company in my portfolio I want to talk about today. And that one will be QXO. As you can see, this is one of the few stocks I'm actually still in the green. Now, I'm only in the green by 5%. For those of you that have watched my previous videos, I was significantly more in the green before. Now, with this company, forget the history. This is all irrelevant. It is a completely different company now. New name, different management, and brand new objectives. So let's focus on the 1 year here. This is a stock that's performed exceptionally well, up 63%. If you bought this thing 3 months ago, you're in the red. If you bought it a month ago, you're down 6%. Lucky for me, I didn't buy it at any of those timelines because I'm up 5%. So let's talk about it. Now, QXO honestly hasn't had a ton of news recently, but this is a company where I do feel like the valuation maybe got a little bit out of hand and now it's coming back to earth. So for those of you that don't know, QXO is ran by a guy named Brad Jacobs. He is the man behind XPO Logistics and United Rentals, two of the greatest compounding machines in history. QXO is his next act. The business model is simple. The North American building products industry is massive, about $800 billion, but it's incredibly fragmented. Run by thousands of mom and pop distributors, QXO is the roll-up play. They buy these smaller players, plug them into a high-tech AI platform, and squeeze out massive efficiencies. Right now, QXO is the largest publicly traded distributor of roofing and waterproofing in North America, and they just grew their 2025 sales to $6.8 billion. But that's just the first inning. Jacobs' goal is not to compete, it's to reach $50 billion in annual revenue within the next decade. And man, that is a lofty goal. And if he is able to do that, which I believe he is, because he's done it so many times before, then this stock could really take off and be a huge contributor to my portfolio. That being said, I'm not looking to add just because my portfolio is rather small and it makes up a fair amount of it, and it is a more volatile asset. That being said, I expect this company to do very, very well. And well, that's it for my portfolio recap since I've been gone. I just wanted to do a little overview of a lot of the stocks in here and just sort of talk about how I'm currently feeling about them. And I love all of them at the moment. I think I don't love stocks. I don't love stocks because, you buy, you sell when it makes sense. But I think they're all in great spots to be profitable in the future. And that's really what I wanted to say. And expect me to get back into more individual stock deep dives and more portfolio review stuff in the future. Well, thank you guys for watching. Have a great day. Peace.